Good afternoon, everyone. I'm Anurag Joshi. I'm a news editor at ET Now. We have an esteemed panel of speakers today who will give you a 360-degree overview and informed insights about the growing and practical relevance of family offices in India as our country, the world's fifth biggest economy, is poised to leap towards the third largest and become a $5 trillion economy. It's a subject I'm sure everybody in this hall is interested in. India's economic rise in the last 30 years has helped generate a growing number of billionaires and ultra-high net worth individuals and families. In this backdrop, a fast-growing number of family offices are providing professional and institutional approach to wealthy Indian families. So, let's start with you, Umang. There are, according to some estimates, if we take the conservative 150 and a liberal estimate is 300 family offices which are operating in India. Give us a sense about the future landscape of this industry as a large number of wealthy individuals and families grow, and so does the necessity to manage the surge in wealth.
Thanks, Anurag. So first, let me just put some numbers on the table, and then it's quite obvious that how family offices are going to grow. So just looking at only families which have 30 million US dollars and above wealth, which are going to get created in the future. So right now we have 13,000 such families. It's going to 19,000 in the next 5 years. So which means you've got 3 individuals every day which is joining that club. So needless to say, when you're having such kind of growth in the HNI and hence the family office segment, this number, as you mentioned, is around 300. I'll not be surprised if it goes to 1,000. So that's one. Second, you asked me about the trends. I think trends are, one trend which we are seeing is most families are doing single family offices rather than multi-family offices. Second trend which we're seeing is the rush towards alternatives, so which we'll come to probably in the later part of the panel. And third is inquiries about international investing. So these are the 3 trends which I'm seeing.
Umang, Rohit, you'd like to add?
Sure. I think coming at the back of Umang is always easy. He's covered the broad numbers. But I think few things are just very stark. The whole basification effect that's happening with India, the amount of wealth getting created is just enormous. And I think just to put one metric here, which is quite simple, is as the country is growing, about 7%, just to put numbers in perspective, there are obviously people who are growing at 0, 3, 4, some numbers, but there are also people who are growing at 15, 17, 20. Now that's what we're talking earnings, income, etc. When you talk about liquid net worth, that's compounding. So when you think about it, when the country has a segment of population that's increasing its earnings and income by 15 to 20%, the liquid net worth is going to levels which are unbelievable. And that is then driven by the desire to create an intellectual effect that's being driven to create business in the long term, strategic alignment. So I think we're just going to see an enormous amount of family intellect, a family wealth, and a family patient capital just come into the mix in a dramatically different way than it has so far.
Thank you, Rohit. So globally, there has been a mounting shift towards alternative investments. And if I cite Goldman Sachs, the proportion has hovered around 45% of the assets that family offices manage globally. Is this an area that's attracting more attention from family offices in India today? And as an asset class, what are your thoughts about the growth of alternatives in India? Anirudh?
First of all, thank you so much, Anurag. Great questions. I think, family offices inherently, especially from an Indian context, are looking to better what is already out there, right? So they're always looking for the next best thing in that sense. So, mutual funds was first. Now mutual funds has become ubiquitous, right? So now you're looking for, then the AIFs came in. Now family offices, everybody's investing there, so what's next? And that's why alternatives as a class continues to improve in its participation with family offices, because they're looking to beat what is already out there, right? And there's a vast amount of money, like Umang said, that they have to manage. And it's not going to happen by following the same pie curves that are given for, let's say, a middle class investor, somebody maybe managing 1 crore or 2 crores, if with family offices managing upwards of 200 crores, as Umang said, they have a very different methodology of how to generate that alpha. And a lot of that is going into alternatives, because that's where the alpha is going to come from. If you're waiting for the IPO and you're getting 2% allocation for your money, it's probably not going to get you much percentage points on such a large portfolio, hence alternatives.
Shuchi, what is your view on alternatives?
Well, 40% is a very high amount. With our family office, I would say it's significantly under 10%. And we're probably going to keep it around that level. But in general, it's an asset class that cannot be ignored. I mean, globally, historically, it's outperformed the public market equities by 430 basis points. So even though we are an asset, at DSP, we're an asset management company, mostly we've always just been invested in our own mutual funds, which we continue to do so. But this was an asset class that we just could not ignore as a family office for some diversification. In a way, it's also, even though it's an illiquid asset class, it keeps us disciplined because we're not selling at the lows and buying at the highs. So it's a forced discipline, which is what I always joke about. It's in the illiquid element of it is actually a positive element in some ways.
Thank you, Shuchi. Umang, what's your take?
Sure. I think if you look at numbers, I think when you compare mutual funds, as Shuchi was saying, so mutual funds are around 50, 55 lakh, 52 lakh crores to be exact. And AIFs have become around almost 10.5, 11 lakh crores. So I think the number is somewhere around 15, 20% of alt assets generally. But what is interesting is the mutual fund industry has made 50 lakh crores since 1964 when UTI was launched. And AIFs have done more than 10 lakh crores since 2013. So the growth is just amazing, right? Now, but also when you look at portfolios, I think we keep probably looking at client portfolios, doing surveys, etc. A large part of alternative investment is direct in nature. So I would say as high as 50% is direct, and the rest probably could go into funds and maybe private credit and other asset classes, but largely 50% goes directly. So, I mean, interesting asset class, but more, I think, more is happening directly than funds as at the moment.
Now, if you look at the investment journey of Indian family offices in private markets, how has that journey been? And private markets globally still have a level of opaqueness. So how do how does the industry make this section of the market more understandable to the broader family offices in India? Shuchi?
So our journey has been with most family offices in private markets, I'd say first with funds. So VC, funds, meeting a lot of funds. We've invested in many different funds at different stages, from early stage, late stage, growth stage, etc. And we have to then decide which GP we feel we like is best suited for us, we trust. And then we've seen their portfolio companies. Sometimes we've met with them. Sometimes we've done co-investments with these funds in portfolio companies, some strategic, some not as strategic, just because we were interested in the idea. And I think that's usually the journey for family offices. And then maybe there'll be some direct investing as well, that deals come directly to the family office by just being in this space. But I don't know if I've done a few direct investments, I mean, personally, and also through the family office. I feel it's always better to be cautious doing these, because if it's not being vetted by a VC that we trust, then you may be getting the lemons. You might be getting those deals that everyone else has passed on, and they're just wanting to raise money. Maybe even a fund you've invested in wants that company now to be raised for the next round. So then they're coming to you with that portfolio company, and you're wondering why other VCs are not now investing in that company, why there isn't a new lead investor. So you have to really trust your GP. There can always be this agency fiduciary sort of conflict. So trusting your GP, picking the right GPs, that's very important, and being a little cautious when investing directly in companies.
Rohit, you'd like to add?
Absolutely. Actually, I couldn't agree more with what Suchi just said. I think if, picking on what Umang said, if mutual funds really 20 years ago came of age, really in that sense, you know, it was about 20 years ago, if today's private markets kind of looks back to that day and kind of gets inspired, the one thing that comes simply is if that's where stock picking struggled with, and you would leave fund managers as the best judges of where capital would get allocated, it's no different. It's no different today with where private markets are. Finding the needle in a haystack in a direct investing is as fraught with risk as anything could be. And dealing with seasoned fund managers, like Suchi was saying, finding the right GPs you feel temperamentally, strategically, thesis-wise, sector-wise, that you feel you can back with, I think is the way to go. I also want to just pick one thing, you know, endowments globally have really shown the way. And endowments and families are not very different. They have pretty much the same objectives. Endowments are driven by positive growth, beat inflation, and last for generations. It's very similar for family offices. And therefore, if endowments over years and years and years have been building their private market corpuses in a very systematic, very rigorous way, depending on diligence in a great way, partnering with the GPs they think they can partner with, I think it's that same journey. It's the same journey which will be repeated by family offices.
Anirudh, do you have a view on private markets and how can this be made more understandable to family offices in the country? And
I think obviously we're also living in an age where information is much more free-flowing, right? I'm just going to add on what has already been discussed. It's important to realize that, you know, innovation can no longer happen on a quarterly basis. That's what the stock market needs you to do. While when you look at private investing, you're obviously investing in things that are, you know, probably going to have impact years later, right? Sometimes you're investing today not knowing, like imagine the people who invested in ChatGPT, right? It's taken the world by storm in the last 12 months or so, but the investments were made far before that, right? And imagine the billions of dollars sunk into something that no one knows about. And there's no way on a quarterly basis you could ever evaluate that because they just started even turning revenue maybe 6 months ago when they came out with the paid plans. It's quite difficult to do it in India, but if you have a global credit card, it works. So this kind of innovation requires patient capital. It requires a little bit more leeway to the founder and the founding team to not be at this rigmarole that the listed space has, right? That every quarter you have to show earnings growth, you have to show revenue growth, you have to show profits, and then you also have to be able to estimate what you're going to do next year, and then you get penalized if you miss your own estimates, right? That is very difficult in private companies, early stage tech, or even, you know, companies like a ChatGPT to really estimate that. So I think that's where private markets come in. That's why family offices are required, like Rohit said, that's why endowments are required, because they're literally investing in things that are going to be groundbreaking for the next 20 years. And that's going to take some time, some patience, and that's why private markets supremely important, and any family office obviously is finding excitement there as well, right? It is definitely an exciting world to know you're investing in the next rocket that India is building, or the next LLM that is going to transform some entire industry. It's quite exciting.
thank you. And how would you judge diligence and post-investment monitoring standards of Indian family offices? What improvements can be made? What best practices can we bring in? Rohit, you want to give?
Yeah, I think that's the centerpiece of the excruciating rigor that this asset class requires. It's a great asset class. We all know it's historically over decades outperformed public markets. It's however having its own challenges, right? It is illiquid, it's long-term, information is dense, it's complex to understand, all of that. And therefore, I think at the heart of private market investing is diligence. It's partnering with someone, it's either incubating that competence in-house or partnering with someone through whom you have that rigor instilled in the process, and then backing a few. But I think the most important thing starts thereafter. It's the partnering, it's the monitoring, it's taking positions on the LPAC. It really is. And you might not be able to do it as a family office. You might be able to do it through a proxy vehicle. You might be able to do it through a consortium. But yeah, it's taking those pivot positions where you can really drive your belief, you can back the GP, and you really can get the results you really want to get.
Anirudh?
See, I think Umang brought up a very interesting point, and I'll just add again to what Rohit has said. AIF really took off in 2013. Most funds have a 10-year life. You're literally seeing the payback of the first round of AIF investing. It started maybe 6 months back, and it's probably going to flow for the next 18 months. After that, you're going to have the standards that should have been built for due diligence, right? Because we're still learning in many ways. That getting said, family offices that have, got children that have studied abroad, right? And they come from that ecosystem or they lived abroad. They have already started getting a lot of the data from their own peers in other ecosystems of how to evaluate funds in India. How can we partner with them, right? It's no longer a passive investment style. It's a very active investment style. Family offices are extremely engaged. They're looking for ways to help beyond just putting in money. And within our own funds, we've seen family offices go to the extent of providing, distribution help. They've provided help with, delivering debt programs, working capital, opening doors. They really are trying to be as active as possible without taking over the role of the investment manager. That's what Suchi said, right? You still need the professional managing the investment. But family offices want to be way more involved than just sitting outside and waiting for a quarterly report or some AGM to meet the founders. They're finding ways. I'm surprised by how many people actually read the monthly newsletter that I write, right? And the responses I get for it, or the quarterly reports and how much people really know about these companies. It just tells you that there is a need for them to know, and us as fund managers should provide as much information as possible to them because they're really looking to help.
Umang?
No, as I think Anirudh also mentioned, I think as the first returns come out, and plus we have data from agencies like Preqin in the previous presentation, I think more and more families are getting aware. Second, I think there's a trend which is coming about is also looking at secondaries, also looking at funds which have a known pool. So these kind of innovations are coming in where you look at established managers and probably get in. There are a lot of side letters being written by the legal team which kind of ensure the best governance which happens.
Suchi, what would you say?
I mean, like I said before, we really depend on our GPs and on the funds that we've invested in to do the due diligence for us, the analysis, etc. Most family offices don't have large teams, and then we don't have teams dedicated specifically to this asset class. So it gets very cumbersome if there are a lot of line items in our sheet, and that there are multiple companies which now have added to, I feel, in the last 2 years. And it's much easier if you've just invested in a few funds and they're doing the due diligence and you trust them. Having said that, I mean, for example, there's one company, and I didn't invest through a fund, and we just literally yesterday just heard, oh yeah, where a fund that was going to invest in the company, it just fell through. And now the company hasn't paid salaries in the last 2 months, and it's not doing well, and it's come to that like major liquidity crunch situation. And I don't think a lot of the large institutional investors even knew that this was the state of the company and how desperate they were for this round. So you do rely on your GPs, you do expect them to know what's going on, but sometimes they have invested in a lot of companies and they may not know every detail of the cash flow situation in the company. And especially when they think of big funding round is coming through. So it's difficult. It's very, very difficult, which is why I feel safest to just be investing in funds and then maybe do a few select co-investments with the funds and companies that you feel very positively about and the fund feels very positively about.
So is there scope for family offices in India becoming more institutionalized and more professional to deliver effective intergenerational transfer of wealth? Suchi, like,
I mean, there's always scope to improve and professionalize. Different family members may have different needs and requirements. Some might require more liquidity than others, might require some, regular income flow, while others might not need the same levels. Some might want to live in India, some might want to become NRIs. There's a lot of things family office can do as they professionalize. Tax planning, estate planning, just all sorts of different needs and requirements of family members, even for charitable sort of donations. Different family members might have different interests. So I think there's always an opportunity for family offices to really professionalize. And we've seen a few family offices, Premji, etc., that have done a really good job of this, even Patni Family Office. So there are a lot of family offices that I admire and would be great to get to their level. Also, we are members of certain family office networks like Camden and IKEA, and so we just learned a lot from different family offices and learned their best practices. And then, different family offices are very helpful, and they're willing to share what works for them and what doesn't.
great. Now that brings me to Gift City and regulation. Now IFSCA allowed family investment funds and the family offices to set up units in Gift City and to process investments globally. Now, IFSCA has also approved, given an in-principle approval to the first set of family offices, and Premji Invest is one of the names that's come in the media. Now, allowing family offices access to Gift City, which is touted as India's international finance center, would that really expand their reach to global markets and assets? And what do you think the government and the regulators need to do to boost Gift City's relevance? Anirudh?
I think there's a lot of questions in one question, but I'll take it one at a time.
Yeah.
Anurag, so I think let's just talk about global investing for family offices. I think it's extremely important. We're going to learn a lot more by investing in more developed ecosystems. And if you look at the frontier markets that are going to come up, like you're going to have Africa, you're going to have Southeast Asia. These are massive markets. I mean, Africa itself is the size of India, right? 1.3 billion people there as well. If you look at Southeast Asia, Indonesia's at 400 million people. And there's some significant market size and a lot of innovation happening. And I think India, as a government, as a regulator, should support family offices that are looking to make inroads there, because we're going to find the next level of really cutting-edge innovation over there. That getting said, initiatives like Gift City, definitely very important, because it gives a proper channel for the money to go out of the country, and there's proper reporting happening for it. Can it be made easier? I think when it comes to regulation, we always want things to be extremely easy. But I don't think we can look over some very important aspects, because you don't just make laws for the good people, you make laws even for the bad actors. And just because you let some good actors through, you might end up letting some bad actors through as well. And that's why these things take time. And I'm glad that the regulator is engaging and has always been active in dialogue with both fund managers and family offices.
Umang, I know you have some thoughts. Go ahead.
Yes. So first of all, I think the regulator in Gift City, I think, is very, very engaging and proactive. So we've never seen so much of proactivism actually with the regulators. So that's my first point. Second, what you'll also see is not only the FIF, which is the Family Investment Fund, what's also going to happen is a lot of our asset management companies locally will set up offices in GIFT, right? To probably launch schemes and products which can be used by family offices, also can be used by HNIs, so that they can choose from the products which probably are there from the asset manager's table to diversify into international investing. So that I think is clearly going to be a trend of the future.
Right. So family offices, broadly speaking, I mean, they started off with a reputation of passive investing. I just want to know about, the transformation in India for family offices becoming more informed and more involved investors. Suchi, you have any thoughts on this?
Yeah, I mean, if you're specifically referring to private markets, there are a few companies where maybe we've taken a slightly larger stake, and then we will be more active. For example, at Blue Tokai, I'm on the board now. We invested, I think, in 2018, and subsequently been investing more. And so that I am taking, a more of an active role in representing the family on that company. And then there are a few other companies that maybe have invested in the early stage that, are still quite small, and then I try to help them as well and see what best I can do. So like Anirudh also said, family offices are more interested in seeing how they can get involved, especially if there's some sort of strategic angle and fit with the family office. And we do our best to see what we can do to help these portfolio companies. Because imagine if there's so many family offices invested, even through a fund, there's access to so many different people and so many different opportunities for these companies that they wouldn't otherwise get. So the more active a family office can be and they're willing to help, it's great for these companies.
Anirudh, would like to add?
So I think, I'm just, what Suchi said is absolutely accurate, right? I think number one, the number of family offices has increased, right? Exponentially. And while they're looking for access through fund managers, through GPs, they also want that feel of the touch and feel, right? That they want to be involved. Many of them have already had their liquidity event. They've sold the main business. So they're sitting, looking for an opportunity to contribute and give back. It's a trend that's only going to improve. It's only going to continue. And as we have this multi-generational family offices that happen in India, we've only seen a few families that have been able to do that so far. I think there's going to be family members that are going to become full-time professionals managing the family office. So now you'll have a full-time person managing the wealth, and that will be part of their KPI, KRA job to be fully involved with fund managers or with their portfolio companies or in the direct investment style. And it's a trend, I think, only improving, and in the digital age only becoming deeper.
Rohit?
I think there's 60% of the families are going to go through, in the next 10 years, an intergenerational shift of wealth. I think the next generation coming in has just a very natural flair with this asset class. It's almost like being born to the mobile age, right? Just like you're born to the mobile age, you're born to the internet age. I think the next generation coming in is born to the private markets age, if I can so use that word. And I think if they are just not going to be passive. I think we're going to see very active participation. And that with innovation, that with disruption, that with everything one's talked about over IVC in the last day and a half, I think is just going to play very naturally to families increasing their exposure and doing it very comfortably because they'll be doing it as part of a natural skin. So that's what I think, Anurag.
Now I'll throw the floor open for questions.
I'm Radhika Rajan. I'm with the DSP Family Office. Actually, my question is for Umang. So you said that, in the last X number of years, the private markets, the AIF have made so much more money than, I forget the exact stats that you quoted, than the public markets. However, most of the gains from that have actually accrued, I would say, to the GPs, right? I mean, it's not that the investors, whereas if you're investing in public markets, the gains, the fee structure of these.
Yes, that's a very valid point, but let me go back to my stats which I mentioned. So when I said 50 lakh crores of MFAUM is largely the current value, whereas when AIF say that they've raised 10 lakh crores of AUM, that's the commitment value. So the value could be maybe 20, 25, 30, whatever the case may be. And of course, post that. But when you look at these two numbers and put them in context, the AIF market on a current value basis is significantly probably as much as the equity AUM in the mutual fund industry.
I think my question referred to the gains made.
Yes. So the gains.
So which means actual exits and so on and so forth.
Yes.
And
So
funds
now coming to the
distributed.
fees part, so a lot of private equity funds have realized that 220 doesn't really work, and many of them have kind of rationalized to more like 1.5, 15, or sometimes even lower. And it's an Indian kind of innovation that the higher money you put, the cheaper fees do you get charged, right? So, so we have a lot of family offices which have that benefit that they don't need to really pay that 2 and 20, and probably for them it's like 1 and 10 or lower.
Thanks.
Who wants to go next? Anybody? Okay, I see there are no further questions. So we will end this interesting panel here. My thanks to all the esteemed speakers, who gave us such great insights into the relevance and into the growth of family offices. Thank you very much.
Sorry, could I just interrupt 1 second? I feel my sister will kill me if I don't give out this stat, but the DSP small cap fund, for example, in the last 10 years, and that's something that you could maybe compare, right, to this private market investing, has given us a return of almost 25% IRR. Now, IRR is sort of what you will need to sort of track, right, to really see now your investments in these AIFs, how they're going to perform versus the public markets. And I know the small caps have really run up recently, and the market has really run up. But I mean, there are a lot of funds that we invested in. There's a fund we invested in 2010. I don't think it's going to probably give us better than a 13% return pre-tax, probably, right? And that's like a 20% tax. And if we had just invested in 2010, Jan 1st, in our small cap fund, we would have gotten a return of 20.4%, I think, or something. And that's over 13 years, right? 13, 14 years, compared to us putting it in this AIF at that time. So in a in a PE, VCP fund. So just, think about that stat as well, because actually, practically for us, maybe we should have just invested everything in the public market.
Any of you guys have any thoughts? Rohit, Anirudh?
We need to help you with diligence.